Welcome everyone. Today in our agenda, we will cover the sectors in our stock market where FIIs have reduced weightage, the sectors where FIIs have been buying, what has historically happened to the stock market during and after persistent FII selling, how can we know if stocks are about to make a sharp turn, possible scenarios that could play out, and finally, I will share my portfolio strategy for any of these scenarios. And stick around because I will be discussing specific stocks as and when they come up. Let's begin. The headline numbers of FII selling in Indian equities looks large, and for many investors, this triggers a familiar fear. If FIIs are exiting, is the stock market crash coming? However, the data tells a very different story this time. Let us break down this data. Let's first quantify the flows. Over recent months, FIIs have recorded a net outflow amounting to more than 1 lakh crores only in cash. Historically, similar episodes in the 2008 crisis, 2013 taper tantrums, and 2018 emerging market risk off had led to very sharp corrections in stocks. But this time, Nifty did not collapse. Drawdowns remained contained, and volatility spiked but remained under control. This is unusual, and it signals that the demand structure for Indian equities has changed. The main reason behind the subdued impact has been that FII selling has been very selective, not broad-based. Major reduction in stakes was concentrated in IT services, Pharma and FMCG, all sectors that are traditionally dominated by FIIs. Interestingly, each of these sectors had specific policy or valuations-driven triggers that can explain the selling. Weak US enterprise spending and visa policy uncertainty affected IT. Margin compression and tariff pressures affected Pharma, while expensive valuations and localized competition hit FMCG. The worst hit stocks are MCX, Paytm, CAMS, IEX, TCS, Infosys and ITC. For most of these stocks, I have one of two paths to investment. Either I invest in the blue chips for the long term right now, or wait out the period of FII selling and then go long in futures once there is a definite turn in FII behavior. Any other form of short-term trading is very likely to fail because in extreme volatility scenarios, technical indicators and fundamental models generally produce subdued results. Interestingly, these are all globally linked sectors, trading at high multiples with earnings visibility slowing. So, a selling in these sectors shows that FIIs have rebalanced. They did not exit India outright since they also invested in other sectors. Data from sectoral flows shows FIIs moved towards domestic growth beneficiaries, banks and NBFCs for their pristine asset quality and balance sheets, auto and auto ancillaries for domestic demand recovery, capital goods for multi-year order books and revenue visibility, and finally metals and utilities for the commodity cycle and power demand growth. The most bought stocks were SBI, L&T, Maruti, NTPC, JSW Steel and Eicher Motors. This shows that FIIs are effectively aligning with India's internal demand cycle rather than its export cycle. This is a major shift in allocation and a brilliant opportunity to capitalize if we can pick the right stocks. One of the stocks that I've talked about for a long time has been making new highs regardless of how the market has been performing. Knowledge Marine Engineering Works. FIIs have allocated about 10% into this company in just one quarter. I would buy in large dips since this is a multi-year story. Coming back to FII behavior, let us now look at what history tells us about market behavior during and after FII selling. Empirical themes across episodes in 2008, 2013, 2018, COVID and 2021 tell us that in the short term, FII selling is higher volatility and often large price falls, especially in large cap or index leaders where FIIs are concentrated. However, central bank or domestic policy response matters. In the 2013 taper episode, RBI tightened liquidity which worsened the situation for our markets and currency. Conversely, in 2025, the RBI has front-loaded its triggers for economic recovery. This policy response can blunt or amplify sell-offs by a significant margin, and in 2025, it is working to support the financial markets. Domestic institutions and retail SIPs can also offset FII outflows. Over the last several cycles, DIIs have been natural buyers during FII selling phases, but offsets are imperfect and sector-specific, meaning sectors that DIIs focus on will likely outperform, while others suffer. In this cycle, those sectors would likely be power, defense and domestic consumption. However, recovery timeline varies and there are always signs that markets can finally bottom and recover, such as corporate earnings remaining stable, domestic buying remaining steady and global risk sentiment normalizing. The recovery can be weeks to many months depending on severity. 2013, for example, saw sharp short-term pain followed by recovery as global policy clarity returned. 2008 was an entirely different story. Let us now make a quick quantitative comparison between SIPs and DII strength versus FII selling. Here, an interesting picture emerges that can explain the difference between short-term movements and long-term behavior. Using the best public numbers for scale from September to October 2025, SIP monthly contributions amount close to 30,000 crores, while FPI net selling in September 2025 was 2.7 billion or around 22 to 23,000 crores. Over July to September 2025, FPI has reportedly sold 76,600 crores, but DIIs or mutual funds cumulative 25 inflows were 4.17 lakh crores, which comes out to more than 1 lakh crore per quarter. So, SIP inflow can offset a typical monthly FPI outflow easily, but FIIs concentrate on large caps and ETFs. Their selling impacts index leadership and valuation multiples disproportionately. Even if SIPs and DII gross flows exceed FII outflows in rupee terms, the market's microstructure, which is liquidity, concentration and leverage, can make FII flow swings produce outsized price moves in certain names. Very simply put, even if DIIs can significantly outpower FIIs in rupee terms, in the short term, large downsides cannot be ruled out because DIIs cannot be as liquid as FIIs are. Which side wins depends on persistence over the long term. If SIPs and DIIs continue to add every month, they tend to dominate pricing over time, but shocks from renewed global risk-off can quickly reverse flows. The single biggest threat to the Indian equity market is not FIIs, but a change in SIP behavior that can be triggered by unemployment, economic downturns, or unusually high credit risk, each of which is a very real possibility today. Bottom line, in rupee flow terms, SIPs and DIIs are large and sticky enough to blunt many FII outflow episodes, but FIIs still control leverage, ETF flows and valuation signals, so they can cause concentrated short-term pain. Think of it as sticky domestic floodwater versus abrupt foreign tidal changes. Both matter. Now, there are three possible scenarios that this could play out. First, quick normalization, which would happen if FPIs return and domestic flows remain steady. It is the base case for most economists today if global policy becomes benign and corporate earnings stay good. Market recovers within months. I, however, disagree with these economists. For me, the more likely scenario is a prolonged risk-off. FIIs continue selling, pressure on large caps and index multiples remains, and domestic buyers cushion, but valuations compress. Cyclical or quality large caps outperform if rotation holds. Finally, the least likely scenario is where domestic flows dominate. If SIP flows accelerate and DIIs keep buying while earnings remain resilient, markets hold up and can even re-rate domestically favored sectors. But this requires sustained retail confidence and sharp economic growth. Regardless of these scenarios, my strategy though remains the same. I'm almost all cash right now, but I will be buying as and when I see opportunities. I'm going to maintain any SIPs I have in the market. Market resilience is now structural and not temporary. However, I must acknowledge that my SIP returns will only be 12 to 14% per year over the next 20 years. I'm not going to get the 30% per year that I got from 2020 to 2024. Where I am investing directly, I will be overweight domestic demand sectors, banks, autos, capital goods, power and industrials, and underweight on global or high PE export sectors, IT, pharma or premium FMCG until valuations normalize. So far, this has been a rotation, not a collapse. Smart capital is simply shifting from global growth to domestic growth sectors. Nothing to fear so far, but what will really happen, only time can tell.